You have probably heard two very different things about term insurance. Some people say it is the smartest financial decision you can make. Others say it's a waste of money. So the question arises, is term insurance worth it? Because you pay for decades and get nothing back if you survive. Both opinions are stated with complete confidence. Most people end up confused about who to believe. In this video, we are going to test both claims against real scenarios. What does a term plan actually cost over 30 years? What does a family lose if you do not have one and something goes wrong? And for the people who feel like paying premiums with no return is a bad deal, we will look at it. What the alternatives actually look like when the math is done properly. By the end, you will have a clear, honest answer, not based on what sounds good, but on what the numbers actually say. Let us start with understanding term insurance. Term insurance is a life insurance policy that covers you for a fixed number of years. It lasts for a specific time period, such as 10, 15, 20 or 30 years. If something were to happen to you during that period, your family would receive a lump sum payout that keeps them financially secure. Term insurance is not an investment. It is not a savings plan. It is not a tool to grow your money. Term insurance is a pure protection. Its only job is to replace your income for your family if you are no longer there to earn it. That is it. That is the entire purpose. When you understand this, the waste argument immediately falls apart. You do not call your car insurance a waste because you have not met with an accident this year. You do not call your health insurance a waste because you stayed healthy. The premium you paid bought you something real. It bought your family a guarantee that if the worst happened, they would not be left with nothing. Term insurance works the same way. You are not paying for a return. You are paying for a promise. The promise that your EMIs will be covered, your children's education will not stop, and your family's life will not fall apart financially because you are gone. Let us run the actual math here, because this is where most people change their minds. Say, you're 30 years old, earning 10 lakhs a year. Your family depends on that income. You have a home loan of 30 lakhs outstanding. Your children are young. Your parents may need support. Now imagine something happens to you. They have to manage the home loan, the household expenses, the children's school fees, and everything else on whatever savings you left behind. In most Indian households, those savings run out in under 2 or 3 years. Now imagine the same situation but with a 1 crore term plan in place. Your family receives 1 crore. The home loan is clear. There is money left for your children's education. Your spouse or family has the financial breathing room to rebuild without panic. The premium for that 1 crore cover for a healthy 30-year-old can be as low as 600 to 700 rupees a month. That is roughly what most people spend on streaming subscription. And what is it? A 1 crore safety net for everyone who depends on you. Now here's the question most people skip. Not whether to buy term insurance, but how much to buy. This is where the tax-saving mindset causes the most damage. People buy a 25 lakh policy because it hits the ATC limit and call it done. But 25 lakhs for a family with ongoing EMIs, young children and no other income source is not coverage. It is a temporary band-aid. We have made a full video that helps you figure out exactly how much coverage your family needs, step by step, using the 9 formula. The link is in the description below. For now, a simple starting point is 10 to 15 times your annual income, adjusted for your outstanding loans and existing investments. So, if your annual income is 12 lakhs and you have 20 lakhs in outstanding loans, your ideal cover is somewhere between 1.4 crore to 2 crore, not 25 lakhs, not 50 lakhs. If your family's annual expenses are 8 lakhs a year, a 25 lakh cover runs out in just over 3 years. A 1.5 crore cover at the same time spending rate gives your family nearly 18 years of financial runway. That is the difference between a policy that protects and one that merely exists on paper. Let us talk about why so many people feel their insurance is not working for them. In most cases, it is not the product, it is how they bought it. The first mistake is buying it only for tax savings, which we have already covered. You end up with a policy that is too small, too short and designed around a March deadline rather than your family's actual needs. The second mistake is buying it too late. Life insurance premiums rise roughly 8 to 10% for every year you repay. A 25-year-old pays significantly less for the same cover than a 35-year-old. And once you lock in your premium, it stays fixed for the entire policy term. Every year you wait is money you are leaving on table permanently. The third mistake is ignoring the policy tenure. Some people buy a 20-year term plan thinking that is enough. But if your home loan runs till you're 58 and your youngest child finishes college at 25, your responsibilities do not end at 50. Your policy should cover you until your youngest dependent is financially independent or until your retirement age, whichever is later. For most people in India, that means a policy running until age 60 to 65. The fourth mistake is skipping riders. Riders are low-cost add-ons that dramatically expand what your policy does. An accidental death benefit rider gives your family an additional payout on top of the base sum assured if death is accidental. A critical illness rider pays you a lump sum on diagnosis of a serious illness like cancer or a stroke, giving you the financial support to focus entirely on your recovery. A waiver of premium rider ensures your policy stays active even if you become disabled and can no longer pay premiums. These additions cost a small fraction of your base premium and fill gaps that the base policy alone cannot. Now let us address the objection that never goes away. What if I survive the policy term? I paid all those premiums and got nothing back. This is a completely valid concern, and there is an option designed exactly for this. It is called Return of Premium Term Plan, sometimes referred to as a zero-cost term plan. The way it works is straightforward. You pay a slightly higher premium than a standard term plan throughout the policy period. If you survive to the end of the term, all the premiums you paid are returned to you. If you do not survive, your family receives the full sum assured amount. The trade-off is important to understand. Because the premiums are returned, a return of premium plan costs more than a standard term plan, sometimes significantly more. In many cases, buying a standard term plan and investing the premium difference independently give you a better financial outcome. But if peace of mind around premium recovery matters to you, the return of premium option is a legitimate and well-structured choice. The key point is this: either way, your family is protected. That is what the decision is really about. So, is term insurance worth it? If your family depends on your income, the answer is yes, without a question. The premium is not a waste. It is the cost of keeping a promise to the people who rely on you most. And when you buy the right amount, at the right age, with the right tenure and the right riders, it becomes one of the most efficient financial decisions you will ever make. If you want to explore what the right term plan looks like for your specific situation, ABSLI provides flexible cover options, multiple payout structures, and the ability to add riders that match your actual risk profile. Check out the link in the description to explore a wide range of term plans offered by ABSLI. And if you have questions, the ABSLI team is reachable at 1-800-270-7000. Before we wrap up, here are some FAQs we hear most often about this topic. Chances are at least one of these is sitting in your head right now. Let's go. Is term life insurance worth it? Or is paying for something you never use a waste of money? For anyone with dependents, outstanding loans, or aging parents, term insurance is worth it without a question. You are not buying a return on investment. You are buying income replacement for your family if you are no longer there to provide it. A rupees 1 crore cover can cost as little as rupees 500 to 700 a month for a 25-year-old. The cost of not having it if something goes wrong is not comparable. What are the tax benefits of term insurance under Section 80C and 10D? The premium you pay for term insurance is eligible for a tax deduction of up to rupees 1.5 lakh per year under Section 80C of the Income Tax Act. Additionally, the death benefit you nominee receives is completely tax-free under Section 10D. They receive the full sum assured with no tax deduction. These two provisions together make term insurance one of the most tax-efficient financial products available to salaried individuals in India. Screenshot this. These are the 5 questions every term insurance buyer needs to be clear about before signing anything. If this video helped you see term insurance differently, share it with someone who is still on the fence. Subscribe for more videos that give you the real picture on insurance and financial planning without the jargon.